A man walks into a speakeasy basement with empty pockets and leaves with cash, and a debt that'll follow him for life. It's 1933. The stock market has been dead for 4 years. Unemployment in Chicago is pushing 40%. Banks have collapsed. Savings are gone. And on a Tuesday night, a factory worker named Michael, we know his name from court records, filed in 1934, descends a wooden staircase on the South Side. He needs $50, not to invest, not to start a business, to eat. What happened in that basement, and in thousands like it across the city, wasn't banking. It wasn't even technically legal. It was the shadow economy. And it worked on rules so different from the formal lending world that understanding it teaches us something crucial about what happens when legitimate credit collapses. Let's rewind. Before 1933, Chicago had a formal lending structure. There were banks, the ones that survived the crash anyway. There were salary lenders who operated in storefronts and charged rates that would make your skin crawl. And there were loan sharks. But the term itself is misleading. These weren't criminals in the modern sense. They were entrepreneurs filling a void. When the Depression hit, formal lenders evaporated. Banks failed. Salary lenders tightened. Suddenly, millions of people had no access to credit at all. They had jobs, factory work, dock work, some retail, but wages were cut, hours were slashed, and landlords still wanted rent. That's the opening. That's where our basement lenders came in. This document right here, a loan agreement from 1932, tells you everything. The lender advances $50. The borrower signs. The interest rate, 40% per annum. But here's the twist. That's not the real cost, not even close. The real mechanism was the vigorish, the weekly skim. You borrow $50 on Monday. By Friday, you owe $55. Not because of compound interest, because the lender simply expects a cut every week. It's a tax on being poor, and it never stops. You pay $5 a week for years, and the principal never shrinks. Who were these lenders? Court records show they weren't faceless. Many were neighborhood men, sometimes saloon keepers, sometimes former factory workers themselves, sometimes connected to organized crime, sometimes not. They operated on reputation and enforcement. You paid because everyone knew you borrowed. You paid because not paying had consequences. The enforcement was rarely as dramatic as movies suggest. It wasn't broken legs. It was social. It was public. A borrower who didn't pay faced eviction from his community's trust. In a neighborhood where everyone knew everyone, that was a sentence. Your family couldn't get credit. You couldn't get work referrals. You were marked. What's remarkable is how efficient this system was. No credit bureaus, no paperwork trails, no collateral in the formal sense, just a handshake and a name, and the default rate. Historians estimate it was lower than formal lenders. Why? Because the cost of defaulting, social exile, was higher than the cost of the debt itself. The scale was staggering. Police records from 1934 estimate that shadow lending in Chicago moved millions of dollars annually. That's not speculation. That's documented in court filings, in police reports, in the records of legitimate lenders complaining they couldn't compete. The shadow economy wasn't a side effect of the Depression. It was the Depression's circulatory system. But here's where it gets complicated. These lenders didn't create predatory lending. They responded to it. They filled a gap that formal finance abandoned. A man who needed $50 to feed his family wasn't choosing between the loan shark and the credit union. He was choosing between the loan shark and starvation. That's the systemic irony the exhibit wants you to see. The formal lending world, banks, salary lenders, credit institutions, had created a moral hazard. They'd built a system that only worked when times were good. When the Depression hit, they vanished. The shadow economy didn't replace them out of malice. It replaced them because humans need credit to survive. By 1935, the federal government started intervening. The Federal Housing Administration, the Works Progress Administration, new banking regulations. Slowly, legitimate credit returned. The shadow lenders didn't disappear. They evolved. But their monopoly on desperation ended. Michael, the worker from the basement. His court case from 1934 shows he defaulted after 18 months. He couldn't sustain the weekly payments. He'd found work, but not enough. The lender sued. Michael lost. He owed $200, 4 times the original loan, in a year when the average wage was $1,200 annually. What happened after? The records don't say. He disappears from the files. Maybe he paid. Maybe he moved. Maybe he vanished into the shadow economy itself, unable to resurface. That's the real cost of a system designed for the desperate. It doesn't just fail the poor. It erases them. The shadow lending economy of 1930s Chicago wasn't an aberration. It was a mirror. It showed what happens when legitimate finance abandons the people it's supposed to serve. And it raises a question we're still asking today. When formal credit collapses, what fills the void? And who pays the price? This video is for educational and informational purposes only and is not financial advice. Always do your own research. Subscribe for more deep dives into how lending systems actually work and what they reveal about who gets left behind. This video is for educational and informational purposes only and is not financial advice. Always do your own research.